The problem that people are having, though, is the taxes killing them. Bill Gates, Jeff Bezos, Warren Buffett, they leaked these tax returns somehow. Every human has the desire to leave a legacy. Why pay the tax up front when you can pay the tax later and continue to invest that money? You're not going to be an expert in everything. You have to pick your battles in life.
Hello, everyone. Thank you for watching our recorded podcast, the Innovator Circles podcast today. And you probably know with my first episode of Innovator Circle podcast that we're going to be bringing C-levels executives. And each episode, we will talk about different things like technology, artificial intelligence, sales and lead generation, marketing, finance, business advisory and development, tax and accounting, as well as business and sustainability. So Innovator Circle podcast is a new initiative from Time Research and Innovation and 𝐬𝐿𝐴 Marketing. So we have a specific wing that we tailored to grow our sales, and that is Sales Funnel Accelerator. So with Sales Funnel Accelerator, we have come up with this idea to talk to the industry as well as solve a specific problem, and we named it Innovator Circles podcast. So we have a special guest today, and I will introduce him in a minute. Before I introduce him, I just wanted to let you know, if you wanted to join the Innovator Circle podcast, please feel free to contact us through Sales Funnel Accelerator and through our social media. So we will have a nice conversation and we will solve a problem together, and we're going to be working it globally. So I don't want to spend any more time. I just wanted to introduce our guest, and I will play the guest intro for you. So we have today with us Joseph, and he's from 𝐈𝐬𝐥𝐞𝐫, and he is working long time now for serving specifically tax planning, business advisory, and accounting experiences. He is a legal accounting hybrid with a long history of helping countless companies make sense of difficult financial issues while improving and growing companies. Joseph, thank you very much for joining today's podcast.
Yes, thank you, Dr. Shah. Thank you for having me. Good to be here.
Thank you very much. As you know, Joseph, this podcast is dedicatedly to show people how they can solve problems, and as well as creating a support network with this network, helping each other to solve specifically any problems that they encounter. It could be tax, it could be accounting, and it could be many other problems that is existing in the business space. So I'm going to be asking you a few questions on that regards supporting individual businesses as well as working in this space. So could you please provide a brief overview of your business and share what inspired you to enter in this field?
Yeah, so 𝐈𝐬𝐿 CPA and 𝐈𝐬𝐿 Wealth Management. Well, 𝐈𝐬𝐿's been around since the 1930s and 40s. It was one of the original tax compliance after the 16th Amendment came along that allowed taxation of this. And so tax preparation became a big industry. So 𝐈𝐬𝐿 came onto the scene generations ago. And what we were finding is that people wanted more than just tax compliance. They wanted tax planning. And as we work with clients with their financial picture, their financial advisors were more focused on often on stock picking. Say, if we can grab the right stocks, that's how you make money. There's so much transparency now with the industries and the stock market. People are finding you really do better in your finances if you find stable companies and let them grow. The problem that people are having, though, is the taxes killing them. And so really to be able to merge your financial planning with your tax picture, that's the next level. And that's what we provided. And as people work towards retirement, with my background, you asked about my background. So I have a legal background, went to Pepperdine University School of Law, and licensed as an attorney, not in the state of Oregon. So this unique background, that I think is valuable, where people can see the tax picture with their finance picture and integrate the two. And that's really where 𝐈𝐬𝐿 becomes unique, is because we have this sister company of 𝐈𝐬𝐿 Wealth Management with 𝐈𝐬𝐿 CPA. And here in the state of Oregon, we have a $1 million threshold. It's ranked number 50 out of 50 states for lowest estate tax threshold. Now, the federal government exclusion is about 13 million, and that's going to get cut in half on December 31st of this year. But It's still very high, so most people don't have to worry about that, but the states have a different issue. So I work with clients to help them avoid estate taxation, to move into retirement, to be strategic about their long-term financial planning, but with a focus on the taxes. Less about trying to outguess the market, but controlling your fees and taxes is where you get ahead financially.
That's amazing, Joseph. So to all of our audiences, if you're watching this webinar, although we are recording it and we're going to be live broadcasting it in the future date, but if you wanted to ask anything to Joseph, we're going to be adding his account details on our live as well. You can contact him directly through 𝐈𝐬𝐥𝐶 website as well as through LinkedIn. So, Joseph, I'm just going to jump into my next question to you. You know that you are solving problems, and you have discussed some of it in your previous conversation. So, could you please discuss the key issues in your industry and explain how your efforts are benefiting the clients and collaborators that you are looking after? I think that would be a very important question for the audience to understand how you are solving problems.
Yeah, so clients will come to me with usually one of four concerns. Number one, they want to make good financial decisions. Number two, they want to not just spend their money wisely, but number two, want to avoid taxes. Number three, they often want to transfer money to the next generation seamlessly and smoothly. And fourth, they often want to leave a legacy. I know Stephen Covey, he said that along with the Maslow hierarchy of needs, which is our basic needs for food, comfort, shelter, and our basic needs, he says there's another one that people often overlook, and that every human has the desire to leave a legacy. So sometimes that's done through charitable contributions. It's how your money's being left to the world. So that's an important part of that legacy. So these four areas, clients often come to us. And that second area, the tax picture, gets very complicated. The Internal Revenue Code, granted, that is about 1,000 pages long, but with all of the court cases and the interpretations and the analysis of it could fill up warehouses full of documents. So to be able to pinpoint what's important, that's why tax advisors become important. That's what we do, is help clients with these. And the laws are constantly changing. Mm-hmm. There's been a bit of an outflow. One of the challenges in the industry right now is there's been an outflow of tax preparers. So some people have called it the brain drain. And a lot of the baby boomers went into this profession in the late 70s and early 80s, and people could no longer do their tax returns by hand anymore in the early 80s when the alternative minimum tax came on board, because you had kind of this parallel universe of taxation. People that were high net worth really needed a tax preparer to come along. So the industry ballooned during that period, and these boomers are now retiring. And so that's a challenge in the industry right now. But at the same time, we also have more technology to be able to tackle these problems. But the tax code, it's a different language. And you need somebody in your corner that really understands the language of taxes. And so that's something that we bring to the picture. It's beyond the W-2 and maybe a few charitable contributions and a home mortgage interest. It's people usually that have a business. So really with those three departments, the audit department, the tax department, the client accounting services department, they often funnel clients to the estate and trust and financial planning department. So when people are getting to that retirement phase or are in the retirement phase, then they need the advanced tax planning to avoid the estate tax. Very few people have to deal with an inheritance tax. There's no federal inheritance to tax. There's only a few states in America that have the inheritance tax, and it's kind of a niche situation. So people misunderstand. They think when they inherit money, they're taxed on it. That's not how it works. In fact, they get a step up in basis. They get a benefit. But when somebody dies, you do need to be careful of that estate level. So you want to plan in advance of that. It's too late after the person passes away to be doing the estate planning. It's the strategies you put into place in advance, and I spend time helping people with that as well.
That's quite interesting points, Joseph, I would say, because when you have parents and you think about all sorts of tax things, in the UK is different, in the USA as well as it's different. But if you do not understand what type of taxation you would cater for, it would be difficult. You will lose a lot of money if you do not tailor that to the next levels. So my next question would be to you: who are the clients you aim to help? Like, do they need to have a certain threshold that, okay, you want someone to this range, and how they will benefit out of you work, and what do you deliver to them?
Yeah, so there's some value you can provide to probably almost anybody who is a taxpayer, which is most people. again, in Oregon, if somebody's over $1 million in their total net worth, which in this day and age, you get to that pretty quick when you've got your house worth over close to $500,000, you got a 401k IRA and some other assets, you get to that pretty quick. My sweet spot is business owners who are trying to retire, that are trying to sell their business and want to avoid taxes on the sale of their business. Those are the clients where I can really add a lot of value to them, and in ways that the other CPAs, frankly, in town and across the country, don't have the same options for them. So we can get into that, but kind of big picture, that's hopefully that answers some of your question. That is my key client, is a business owner trying to move into retirement.
That's interesting. Joseph, we're going to be continuing our conversation. So all the viewers, you're watching this podcast. This is Innovator Circle podcast from Time Research and Innovation and 𝐬𝐤𝐶 Marketing Agency. We have a specific brand for sales and marketing, and that is Sales Funnel Accelerator. And we have combined this podcast for you to understand business and different space and spec of the business to get help and inspired. Joseph, what makes your approach unique in helping clients achieving this outcome?
So for most of my career doing tax and financial planning, people would come to me and they would say, I'm selling my business, I'm selling my piece of real estate, I'm ready to retire, I want to move on from it. And my response to them would be, well, you either need to pay the government a third, or you need to turn it over to a charity, or you need to defer the income or kind of get stuck in one of these other programs, or you have to pay the government a third. And the response would be something like, wait, I put $100,000 into this property a generation ago. I'm selling it for $1 million now. I have a $900,000 gain. I was expecting to live off that $1 million in retirement. Are you telling me that I only get $700,000 now because I had to pay $300,000 to the government? And do the quick math, 20% capital gains tax, 9.9% almost of state tax, at least here in Oregon and California, and then the NII tax, or the Obamacare tax here in America, 3.8%. So yeah, it's over a third. So that's the reality, is you just got hit with the $300,000 tax bill. And their response is, well, that affects how I live my life in retirement. That affects a lot of things. Maybe I wait, maybe I don't do it. And I didn't have a good solution for them besides some of these other programs that really tie up their money in ways that they didn't want. So last year, I went to a conference down in Austin, Texas, and I heard some buzz about an opportunity. So this is one of these things where it's probably better to look at the punchline and then work backwards from there. So the punchline is, how would you like to be able to sell your business tax-free or tax-deferred and put that money into a bank account that you can access whenever you want? You have a bank account, a Fidelity account in this case. How would you like that? Well, that sounds pretty good. That's the best outcome you could ask for. Well, that was something that I heard some buzz about a few years ago, and I didn't get more information on it. It just sounded one of these things that I kind of kept in the back of my mind. Then when I went to this conference last year down in Austin, Texas, I was listening to advisors between meetings and between the dinners and of the conference were buzzing about this program that they were using. When I got back to Oregon, I called my regional resource and I said, do you know more about this program? And I called one of my peer group members out in Maryland, and he said, yeah, we've been using this program and it works great. Okay, so now it's time for me to dig in. Now I start using it with my clients. What it's called is the Tax Aware Flex SMA, or Separately Managed Account. Don't get confused by the word Separately Managed Account, or SMA. An SMA is just an account that doesn't hold mutual funds, that holds individual stocks that you can sell those stocks strategically to harvest losses or time the gains as you want to. So the pros of the Flex SMA is you're going to get a tax deferral on the capital gains on your terms. The other pro is it's liquidity. It's an account you control and you have instant access to the cash whenever you want. Another pro is diversification. You can put those funds into stocks or any other securities. You can put into bonds if you want more stability. The cons of the Flex SMA, it requires a $1 million investment. It's not something for smaller investors. Because of the resources required to run the account, they want to make sure there's enough money. Now, keep in mind, family offices have been doing separately managed accounts for generations with hundreds of millions of dollars. And people, when the IRS leaked, Bill Gates, Jeff Bezos, Warren Buffett, they leaked these tax returns somehow. And people are outraged. How are these men not paying taxes? These are the wealthiest billionaires in the world. How are they not paying taxes? Well, these are the kind of strategies they were using, but they weren't accessible to people like me and you. Now with the technology where it's at, you're able to get into one of these programs with much lower thresholds. Now, they're a little bit complex. They might seem difficult to understand. I am happy to talk. I geek out on these, so I'm happy to talk through with anybody as long and as in-depth as you'd like on how they work. There are time constraints. You can't just sell your business one day and get the full capital loss the next day. You would need to hold the account long enough to generate the loss. Again, it's tax deferred, so you're left with highly appreciated low basis portfolio. In the example I gave of the $900,000 gain that would have been offset, that gain gets pushed or deferred because you triggered a $900,000 loss, but the $900,000 gain gets deferred. So this is good for sellers who have a large sale. They want flexibility, when and how much to use personally. They want to avoid taxes. They want options to invest and give to heirs or charity later. Now, keep in mind, it's like real estate owners, they have had access to tools like this for years. The 1031 exchange allows the real estate owner to push money into another property. Now you're still stuck with real estate, and we'll get into that comparison. But the real estate owners, they've also had other things like the Delaware Statutory Trust and the UPREIT and things like that. Business owners haven't had any options. They're stuck. When they come into the office and they say they're going to have $1 million gain, sorry, you're stuck with paying a third of it to the government. Unless you're going to use a charity, and lock up your money, you're stuck. So this changes. This is a game changer. This is the biggest thing. And I talked to one of my partners emeritus who has been doing tax returns by hand since the 70s. This is the most innovative change that has hit the tax strategy world since he's been doing this.
That's great.
This is big time. I mean, here's a sample client that was doing it for 6 months. So in that 6 months, he put $1 million into the program, and his account after 6 months is worth $1,105,000. So he got a 10.5% return on his money.
Okay.
He beat the S&P 500. He beat the bond index. He beat the international index. He was beating all the indexes with this program. That's not the best part of what he did. The best part of what he did was to realize losses of $247,000. This slide was created 4 months after he started the program. If you were to look at this 6 months after he set up the program, it's closer to $400,000. But the point is, he had about $1 million in gains. In this case, this client sold collectibles, and he had $1 million gain. And he had almost no basis in it. So he took the money and put it into this program. So within 6 months, he had about $400,000 of realized losses. Had he had this program all year long, it would have been closer to $800,000 or $900,000 of losses. But again, I found out about the program partway through the year. So we didn't get him a full year. But had I had the program, and now you know that you don't make the same mistake, had I had the program all year, he would have offset almost the entire $1 million of gain. He has unrealized gains. So what's the big deal? You realize gains and you have unrealized gains. Don't you have to pay the tax eventually anyways? Maybe, but maybe not. Here's the thing about unrealized gains. You can take them on your terms. Now, if you take all the gains at once, you're going to push yourself into the highest tax bracket. So what if he takes them out over time? This particular client doesn't have a lot of income in future years. What if he takes those out? He just takes out $50,000 a year, 0% tax bracket, never pays tax on it. Let's say he does have higher income and he gives them to one of his kids in a lower tax bracket. Maybe that kid's in a 0% tax bracket or in the 10% capital gains rate bracket. He gives the unrealized gains to them. Voila, no tax to him and very little tax to the beneficiary. Or maybe later on in life, he decides he wants to give to a charity or he wants to start a charity. No tax when you give unrealized gains or you give appreciated stock to a charity. Maybe he gives it to somebody in a lower tax bracket. Maybe he donates it to a charity. Maybe he realizes the gains when he's in a lower tax bracket. Maybe he just holds it for the rest of his life, just in case he's got major medical expenses of $215,000. And then he can realize the gains if that medical crisis comes up and pays the taxes on it. And if that never happens, then he passes away, he gets a full step up in basis so his beneficiaries can inherit it tax-free. Nobody ever pays the tax. But the point is, you are delaying that decision. You're not stuck with the consequences in the year of sale. And yeah, you do go ahead and pay the tax years later. Well, you basically took a loan from the IRS because you didn't pay that tax years ago and you held on to it. So why pay the tax up front when you can pay the tax later and continue to invest that money? So that's the point of that slide there. The next slide here, some people ask, well, what is in these accounts that they're using to make these investments? Well, you probably recognize some of these companies: Apple, NVIDIA, Microsoft, Amazon, Meta, that's Facebook, Broadcom, Berkshire Hathaway, Eli Lilly, Costco. They're using this program with companies that you and I know. There's no voodoo magic going on here. The market has proven over the past 100 years is that the market goes up and goes down, and you can't predict which direction it's going to go. So what they do, and we'll see on the next slide, is they build a portfolio. So like here, for example, you can see traditional direct indexing. Most of you know the gray bar is, well, if I put $1 million in the stock market goes up, I make money, market goes down, I lose money. Simple as that. Now let's add some layers of complexity onto that. Let's say you take that $1 million and you put it into a flex account. Now you can put it in treasuries, you can put it in mutual funds, almost whatever you want. But what AQR is doing here is they're building a long extension on top of it and a short extension. So as you know, with longs, if the market goes up, you make money. Market goes down, you lose money. But with shorts, the opposite happens. The market goes down, you make money. The market goes up, you lose money. So whether the market goes up or goes down, it's going to be a net zero effect on the long and short extensions for the overall value of the portfolio, but you're going to have losses to harvest. So years like 2024, where we had a presidential election, there was a lot of volatility. That's great for this program because volatility creates losses where you've got longs and shorts built onto your portfolio. The cost of building longs and shorts is you have to borrow money. Well, the arrangement that AQR set up with Fidelity is it costs a little less than 1% net to borrow money because you make money on the shorts because the escrow account earns interest, and you pay interest on the longs because traditionally borrowing money in a traditional way. And those longs and shorts offset, there's about a less than 1% delta. So you're paying a little bit of interest to build these longs and shorts. But I mean, if you're saving hundreds of thousands or millions of dollars, or there's one company that used it to save billions of dollars in taxes, then you're coming out so far ahead that don't go tripling on that little fraction of 1%. I think this explains the program probably the best. Now, this helps us to understand that time is your friend when using the Flex SMA program. Let's say you did direct investing. You tried to manage it yourself, or you hired a professional to do it on your own. You were one of those past generational family offices, and you said, I'm going to harvest losses and defer the gain in my portfolio that you've got right now. Well, they're finding if you take a $10 million initial investment, hypothetically, that you would probably be able to, on your own, offset maybe 3 to 6%. Maybe if you're really good, you get closer to 8% of losses over a 12-month period. Now, if you're using one of these programs, the AQR program has the Flex 145, Flex 200, Flex 225 program. In 1 year, somewhere between 34% and 64%, what they're committing on this chart. And then after 2 years, you're offsetting 100% of the gain. Now, I showed you a live data from one of my clients. And as you can see, the actual returns or performance on these is way outpacing what we're committing here. So this is kind of client-facing material saying here, this is how much losses we can generate in a year for your portfolio, but this commitment that they're making on this graph, they're doing much better. And now keep in mind, the overall portfolio isn't losing money because overall portfolio is growing in value. That middle collateral sleeve is growing in value. What's happening is the longs and the shorts, again, they're a net zero effect. They might take Coca-Cola, say we like Coca-Cola, and Pepsi we don't like. And so we're going to put the Coca-Cola in the long extension and Pepsi in the short extension. And then if the market goes down, presumably they both go down, and then you lose money on the short side. And then market goes up, they both go up, and you make money on the long side. And so it's a net zero. You're not losing money, real money. You are losing money on paper and deferring gains on paper. But for tax purposes, it's genius. Okay.
That's fascinating, Joseph. I'm learning a lot of things from here.
So this is a graph that I came up with to help explain to my clients. So these are the interests that my clients tend to have when they're selling their business or their real estate. Number one, they want to defer the entire taxable gain. Number 2, they don't like minimum investments. Number 3, they like their deferred gain to continue to grow after the sale. Number 4, they like continuous stable cash flows. Number 5, they like low ongoing management. They don't want complications for their life and retirement. Number 6, they don't always want to have to do real estate. They want to be able to do their businesses and collectibles in that case we saw, that other case we looked at. Number 7, they don't always want to get stuck reinvesting in real estate. They want to be able to put it into a diversified portfolio. So number 8 allows for a diversified portfolio. Number 9, or cash. You don't have to put the $1 million into stocks. You can put it into cash if you want. Cash isn't a bad place to have your money right now. Number 10, they want low ongoing maintenance fees. They don't want to get stuck with those high fees. Number 11, they don't like setup fees. Number 12, they want high liquidity. They want that cash available. They don't want to be locked out of their money. And number 13, the investments held in easily accessible account in your name. Number 14, the tax services option included. And then next one is the financial planning services they often want included. So we go through these and we say, okay, what if you do no planning? And you can look here and you can see you don't get to defer the gain, but that's kind of the point of all this. So you're the client that comes in and says, I don't want any plan. I just want to pay the taxes. Well, fine, but you just cut that $1 million down to $700,000. Yeah, you get the liquidity. Yeah, you get a lot of the other benefits. And if that's what you want, have at it. But if you don't want to pay a third of the money to your government, let's find another way. Most Americans are familiar with the 1031 exchange, but again, you're stuck in real estate. You trade one piece of real estate out for another piece of real estate. And my clients, when they're moving into retirement, they're saying, well, the reason I'm selling this property is because I don't want to be in real estate anymore. I don't want to. You can hire a property manager. Yeah, but the property manager calls me and asks what to do about a leaky faucet. I don't want to be dealing with those calls anymore. I want to be done. I want to retire. I want that money to travel, vacation, give to my kids, build a cabin on the coast, beach, whatever. I want a new lifestyle. Okay. So 1031 exchange only works if you're trying to get out of real estate. That's why most of these results are zeros, because you don't have any liquidity and you don't have a diversified portfolio. You can't access the money. The opportunity zone, these were pretty exciting when they came out within 5 years ago? The opportunity zones first started to make their mark. They didn't get quite the traction that we wanted. I think the issue was you had to invest in financially distressed areas. And a lot of people started to think, well, if it's a bad investment before, and even if they give me a tax benefit, do I want to make a bad investment just because of the tax benefit? The charitable remainder trust, I really like these for clients who have charitable intentions. You can defer the entire gain, which is great. No minimum investment. That investment continues to grow. You can get stable cash flows from them. Low ongoing management. You don't have to sell real estate. You can sell a business to get into a charitable remainder trust, and you can get into a diversified portfolio. But you need to talk to an attorney. There's high setup fees. The liquidity is pretty bad on these. If you change your mind and decide, well, I don't want to give to that charity more, I've got a personal emergency, I've got a new charity I like, my kid needs the money, you're stuck. You're stuck with the charitable remainder trust. So that's the biggest downside there. Delaware statutory trust. This one, it's a form of a 1031 exchange. It just makes it easier to find the property. But it has more downsides. They're more expensive. The fees are high. But again, it's like a 1031 exchange where you don't have to find the replacement property. RA's Delaware statutory trust. I really like these. These have a lot of benefit. These ones, again, this has to be a piece of real estate you're getting out of. The fees are very high. The liquidity is difficult. These are really good for people who want to stick with real estate but want liquidity. So you can get some liquidity after you've been in the program for a few years and you're willing to pay the fees. Okay, so let's get to the punchline. What I've been talking about here is the Flex SMA. You get to defer the entire gain. It does have that $1 million minimum, so I'm got to be honest here. There is a minimum investment. I should clarify, if you tried to get into the AQR Flex SMA through most brokers, you're going to have a $3 million minimum. Eisler Wealth Management has a relationship with AQR that we can do it for less than that for the right circumstance. That's why I say 1 million. But you'll see mostly out there, most of their literature says 3 million. Again, that money, it grows after the sale. Like you saw my client there, he had about an 11% return in 4 months, actually. You get continuous stable cash flows. Some people use these and just live off of the dividends and interest for as long as they want. Low ongoing management, you do nothing. Your AQR handles the trades, and so you have no need to be involved with it anymore. You just enjoy the growth and the tax benefit. You don't have to sell real estate. This is one of the biggest points here. The guy mentioned selling collectibles. People sell businesses to get it. They do real estate. Any capital gain you've got, this is a golden opportunity.
Mhm.
Like we saw, it's a very diversified portfolio. You will have hundreds of different stocks. Again, an SMA is individual stocks, and they strategically use that SMA to buy and sell in ways that recognizes losses and defers gains long term. One of another CPA here in town said, "Oh, it's like tax loss harvesting has been around since the beginning of the IRS in 1913. So there's nothing unusual or schemy about tax loss harvesting. It's been around since the beginning. And this is just a way to exploit that tax opportunity. Your fee is going to be comparable to any other financial advisor's portfolio to get into this, and they're not going to have the tax advantages that we've got. Again, no setup fees, high liquidity. Client says to me, I want out. It's like, okay, you have three options. We can either sell the entire portfolio and transfer the funds over to you and recognize all the gains. You're no worse off than you started because you would have had those gains at the beginning. Number two, we close the extensions, and then you just have the account with the stocks the long positions only, and just that original sleeve that you put in. Or number three, you just transfer everything over to you, long, shorts, and everything. You can have everything. But anyway, the point is, it's highly liquid, and it's your account. It's not one of these things where you're sort of locked out or anything. I mean, you can log into your Fidelity account 24 hours a day and see what your account's doing, just like you can any other. You should be able to do with any other account. That's the point. I find it highly innovative and very exciting opportunity for clients to now have another option besides the traditional options that you're seeing here on this page.
Mm-hmm. Thank you, Joseph. It was a really great presentation, I would say. And I did not know a lot of things previously, so it also extended my knowledge. So we're going to get back to conversation. So before I get back to my conversation, I wanted to thank you for joining our podcast, and as well as all the viewers you're watching this podcast. We're going to be going for a commercial break.
You may know CEOs who consume high-value business content grow their companies 4 times faster, and 81% of business leaders say thought leadership content has directly influenced their buying decisions. So, wondering how to accelerate your success? ICP Cast isn't just a podcast, it's your gateway to fast-track business growth. What you'll gain with this program? We will bring exclusive insights to learn directly from top executives and industry leaders. Adopt technology and AI to understand the market and the buying preferences. Build data-driven strategies to foster sales tactics, content creation, and social selling to increase authority and persona. Accelerate transformative conversations to break boundaries, spark innovation, and lead with confidence. On-demand learning to gain expert insights anytime, anywhere, at your convenience. Build a powerful network. Connect with key decision makers to shape the future of business.
So, what are you waiting for? If you are ready to lead your industry with clarity and confidence, ICP Cast is your ultimate tool for success. Book your cast with me today.
Thank you, everyone. So welcome you again, Innovator Circle podcast. We have Joseph from the ISLA. And if you wanted to send him any messages, you can contact him through the ISLA website and as well as LinkedIn and all other social media. So we're going to be continuing our conversation. My next questions, you know that partnerships is a part of your business model. And from their perspectives, what benefits make you an ideal collaborators?
Yeah, so lots of attorneys like to work with us because deal with estate and trust issues across town, and they develop that partnership with us, and we meet with them for lunches because they want strategies to help their clients to minimize taxes. And partnerships are important to us. You're not going to be an expert in everything. Mm-hmm. You have to pick your battles in life. The two certainties in life, right? Death and taxes. So taxes are a part of most everybody's life, and almost everybody's looking for a way to minimize them. So professionals all across the country are looking to their CPAs saying, how can we avoid this problem? Everybody's got a tax problem. I've got a client selling a shopping mall right now, and he says, I'm not sure if I want to use this plan or that plan or this plan. And I said, well, you do have a plan set up for you right now, and it's to pay $2 to $3 million in taxes on the sale of your shopping mall. So you're on a train track right now, and it's going for a giant train wreck. That is your plan. That is the plan the IRS has set up for you. If you want to diverge from that plan, let's have a discussion. But a plan is there for you, and it's a train wreck. Okay.
Thank you very much. I have a related question to you now. In relation with your work, could you please share some insights of the upcoming industry trend and how you are adding benefits to remain ahead?
Yeah, so the trend is towards more taxes in the United States. The national debt is worse than it's ever been. And at some point, with competing interests from other countries, at some point, there needs to be a solution to that, whether it's reducing Social Security payouts, whether it's increasing taxes, whatever it is, the trend is not favorable to the next generation. So people that are willing to invest in relationships with their tax strategists are going to minimize the pain that they're going to feel as the tax rates go higher. And as we saw with the Tax Cut and Jobs Act, and then the threat on December 31st at midnight of that being repealed, the complications of the tax code are only getting worse. And Congress is jerking us back and forth on what we can and can't do. And when people complain, say, hey, you're making things too complicated, their response is, technology's gotten better, so you can handle it. Well, we do stay ahead of it using technology and state-of-the-art options, but artificial intelligence is not to the point where it's able to solve people's tax problems. You need somebody who knows the issues, who can understand the issues, who can identify which ones apply to you and can strategically implement them for you.
I totally agree with you. As a AI researcher and a data scientist, I do understand that artificial intelligence will not solve your taxation problem because it's beyond that limit. Maybe it will take another few years or several years or maybe 10 years for artificial intelligence to talk about the work you do. So that's very interesting, Joseph. Thank you very much for joining today's podcast. And we're going to be having more questions. Next question would be, what are the major obstacles you have overcome and lessons you have applied to your professional approach?
Yeah, the main thing is not to consider one-size-fits-all approaches. People's financial picture is different. People's risk tolerances are different. People's relationships with their families, their wives, everything, it's different. And so throughout my career, I've had to learn something they don't teach you in school. And that is how to tailor every situation. People say, well, it's a tax form. Everybody fills out the tax form the same. No, they don't. If you gave the tax form to 10 different CPAs, you get 10 different strategies or 10 different approaches to filling that tax form out if it's a complicated situation. And I have disagreements with even the CPAs in my own office on the best strategies to use. So really tailoring it to what the client needs and what their risk tolerances are and all the situation about their lives and their financial picture is very important. And early on in my career, I just kind of accepted whatever the financial advisor was doing must be in the best interest of the client. And then sometimes the client says, why do I have such high taxes? Or what happened here? I said, well, this is something your financial advisor did. Well, there's this disconnect. And so now that the financial advisor and the tax accountant are having meaningful communications, now we're able to create a more tax efficient, and that's the biggest drag on people's portfolio. It's not trying to outguess the market or grabbing the latest headline. Problem is things like taxes. We know any of us can grab a mutual fund or an index fund and watch it ride and ebb and flow with the market. That's not the challenge with financial planning anymore. The financial planning are watching your fees, watching your taxes, and implementing your risk tolerance in a way that's tailored to your individual interests and needs.
Thank you, Joseph. We're going to be continuing our conversation. We have a few more questions to ask. Before I jump into my next conversation, I wanted to thank everyone they're watching today's podcast. And if you wanted to ask us any question, feel free to ask us through this broadcast and as well as on our social media, on LinkedIn, and as well as on the website. So we are broadcasting through LinkedIn and all of the social media. And this is Innovator Circle podcast. And we are developing this podcast for C-level executives. So if you are interested to join these programs, please feel free to contact us through the funnels as well as our social media. And we're going to be continue our conversation. So my next question would be to you, Joseph. How do you measure success of your work, both for your business and for the clients that you serve?
One of the ways I measure success is, am I able to solve these problems, and particularly the taxation problem that people have? And we all want to feel like we can bring something unique. You don't want to be a carbon copy, long term at least, of the person in the cubicle next to you. You want to bring something unique to the table. And with taxes, that's no exception. It might sound a little odd because you would assume that all tax strategies are the same, but they're not. And when you can bring something that's to the next level and really help your client to avoid their tax problem and to minimize their taxes and have a more robust retirement. And like I said, those 4 things they want: spend the money the way they want, live an abundant life, and minimize taxes, giving to their heirs and beneficiaries and then their charities in a way that's satisfying to them. That's how I measure my success, is when they've done that.
That's fascinating, Joseph. We are getting into our session. We have a few more questions to ask. And I just wanted to ask you specifically a particular questions. Can you share a story of a particular rewarding project or client success that highlights your impact?
Yeah, so I had a client and they were selling a business too far from here. And the conglomerate that was buying the business came in and said, we'll pay you $1.5 million for the business. We've done some valuations. And this is what we've come up with. And the client comes to me and says, here's what they offered. And I did some measurements and I did some analytics on it. And I said, you really should be asking $2 million for your business based on, and I gave them the report that I'd come up with. And I also showed them how we were going to avoid taxes on that. We're using the Flex SMA strategy. Anyway, they took it back to the conglomerate that was trying to buy their business. And the conglomerate said, yeah, you're right. We should be offering you $500,000 more for your business. And they agreed to that. And so the client obviously was very pleased with that. It changed their retirement. It changed the new home that they were buying down in Arizona, a more beautiful home. And by using the Flex SMA, we were able to avoid most of the taxes on the sales. So that was a very rewarding experience, because it makes a meaningful difference in their day-to-day lives.
I totally agree with you, because Joseph, when you work with individuals, you need to give them trust. And that trust can steer to the next levels if you satisfy them. And that will bring you momentum, isn't it? So we have another 2 questions for you specifically. You have many skills. And in between those skills, what qualities do you believe has been the most critical to your success as an innovator in your industry?
Yeah, so a lot of the best skills are not book learning. I'm happy I learned the language of estates and trust and taxation in law school and my accounting program, my undergrad at Brigham Young University. One of the most important skills is looking for new opportunities, like what your viewers are doing here, looking for innovative solutions and not shutting out things that just because, I haven't heard of this before, therefore I'm not going to explore it, but taking opportunities and looking into them and exploring them and providing the best value for my clients. Because at the end of the day, if my clients aren't satisfied or getting the best, then I'm failing. So it's constantly rebuilding yourself into a better professional. So I don't put up any barriers. I don't put up any blocks for new ideas, innovations, and strategies. I think that is where you're going to find success with people, if they're continually willing to learn and grow. When they're your advocate or your professional and you got somebody like that in your corner, you're going to make a difference. You're going to see differences.
Thank you, Joseph. I just have another 2 questions for you. Are there any misconceptions about your industry and that you like to address and clarify?
There's just a wide variety of what financial planners and advisors are offering. And I think that's a big misconception that people have, is they're basically all the same. And like I said, if that's your thing, you want to avoid taxes, then you need to find somebody who has that niche and that understanding. If your thing is you want to jump in and out of the hottest stock that's on the front page of the paper this morning, that's a different kind of financial planner than me. But really being able to, with ETFs now and index funds and things like, a lot of the financial planning has moved away from the portfolio investments and specifics like that, and really looking for what you need as an individual long term, getting away from what stocks are we picking today. That is not how people are making money in the market. It is things like taxes and risk tolerances and indexes that people are focusing on.
Thank you, Joseph. So we have our last question to you. What advice would you give to aspiring entrepreneurs looking more in your field? So if someone knew they wanted to master in your field, how would you support them, and what advice do you give it to them?
There are school requirements. You get your accounting degree at your university. And if you are practicing in a state that requires a master's degree for a CPA, which I think almost all of them do now, that's where you build the base. You get the language, you get the lingo, you'll know how to communicate with CPAs. That's the base level, but that's not it. The next level is finding podcasts like yours, or particularly CPA. There's several of them out there. Be constantly learning. Find ways to develop your strategy, developing your approach. And I would say if you are willing to get out there and listen and do self-education, you're going to get ahead. And when I say self-education, I'm not talking about the CE classes or CPE classes that are required, the 20 minimum per year, 60 every 2 years that we have here in Oregon. Those classes, they're basically teaching you the new laws and how the laws are changing and things like that. I'm talking about people who are strategic and innovative. You're going to want to make sure you are just a constant learner. And that would be my best advice.
Thank you, Joseph. It was a pleasure talking to you today. And we have learned lots of information. And I also wanted to thank you and to all the viewers, they're watching this recording. And if you have a last remark for the audience to share.
Just thank you, Dr. Shah, for having me. And I love what you're doing to build people's businesses up and make people success and be able to live their dreams wherever they're at. So thank you. Thank you.
Thank you, everyone, for joining today's podcast, I would say. And I will welcome you to next episode, because we are recording series of podcasts from Innovator Circle podcast to get you right information and work together to solve a problem. So until my next podcast, thank you for watching and bye-bye.